You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplified ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today we've got Joseph Wang, who was a former senior trader at the Federal Reserve. So he was at the center of the plumbing of the financial system. So, thank you so much for being on the podcast.
Well, thanks so much for inviting me. I really enjoyed this podcast and glad to be here. You have some of the best guests ever. And, I'm really impressed by all you're putting out.
Thank you. So, could you give the audience a bit of your background and how you actually got into this business? Because it's very interesting. You actually started off in economics and then you also studied law and then financial economics. So could you just talk a little bit about your background, how you found your way into this business, and what was it like actually trading at the Fed?
Yeah, so you're right. I have a pretty unconventional background. I graduated college studying econ and math. But I decided to go to law school instead. Back then, I just thought law seemed like a nice stable career. You could earn a pretty good salary and all that. And that was true, except that I didn't really like practicing law. It seemed kind of boring. So practicing law, a lot of it is just kind of doing paperwork every day. And it's kind of draining and it's not that interesting. I wanted to think about how things work in the world. So I graduated in law school back in 2008, and basically I graduated right during the time of Lehman. And at that time, I became very aware of what was happening in the financial markets. It's hard for anyone to avoid that, right?
Yep.
Back then, the Dow was, teetering hundreds of points a day. People were worried that maybe the banking system might fail. And the Fed was doing all sorts of things that it hadn't done before. There was quantitative easing, and there's a whole alphabet soup of liquidity facilities. And that really piqued my interest. I didn't really understand any of it, but it just seemed so exciting to be able to think about how things work. And to, so I'm sitting in my office, basically looking like page 50 indenture agreement that's like 100 pages long, looking at whether or not there are extra commas, right? But it seemed so much more exciting to be able to think about what was going on in the world. So I really wanted to work in the financial markets. But at that time, it was really hard to make that transition. So I was a lawyer at the time, and the financial industry was not doing well. So in order to make that transition, I had to go back to school. So I went back to school and got a master's degree in financial economics, became a credit analyst, and I worked there for a little bit and saw an opening at the trading desk at the New York Fed. The opening was in the money markets desk, and I wanted to work in something that was macro, and I wanted to be closer to the markets, and so that's what attracted me. And being a trader on the Fed's desk, it's actually not, the trading part is actually not that exciting because the Fed is not trying to make money, right? It's trying to basically be a utility, being a liquidity provider of last resort. So that was not that interesting. But what was interesting, though, is being able to basically be behind the scenes in a lot of things that are going on in the financial markets. The open markets desk is kind of sits at the center of the dollar system. It's the desk that does QE, that does the emergency lending facilities and everything like that. It's basically the ultimate and unlimited provider of dollar liquidity to the entire dollar system. And when you are there, you get to hear what people are talking about. So you have contacts throughout the investment community. You can talk to all the major buy-side funds. You talk to all the banks, primary dealers, money funds. You get to hear their perspectives. And you also have an enormous amount of data that no one else has. So this is particularly true in the money market space. So the Fed has basically transactional data on all repo transactions, for example. So when you want to talk about what's happening in the repo market, the Fed knows more than anyone. So you get a lot of insight as to what's happening. And that's been very interesting to me and very rewarding. are able to learn about the system in a way that it's very difficult for you to do otherwise, simply because otherwise it's very opaque.
Yep, got it, got it. And then you mentioned the repo system there, and so I wanted to start off by asking you. So recently, we've been seeing the reverse repo facility at the Fed. It's transacting at the levels of nearly $1 trillion a day. So what exactly is going on there, and what is your take on it?
Yeah, so I think you can think about this in a few steps. So first off, you have the Fed doing quantitative easing, right? So they're buying 120 billion a month. And so when the Fed does quantitative easing, it's adding reserves in the banking system. That's true. That's the asset side, but it also adds deposits. So basically, there's a lot more money in the system. And that's fine, except for the fact that banks actually have a limit to how much money they can hold on their balance sheets. This may sound strange to you and I, because we can always go to the bank and like deposit whatever money you want, right?
Yep.
But let's say you're an institutional investor and you have a lot of money. I just can't put like $1 billion in Citibank because, well, one is that there's credit risk, and the other is that Citibank doesn't want to hold all that. They have these regulations, they're called leverage ratios, that limit how big their balance sheet can get. So when the Fed creates money and it can't stay on the balance sheet of the banks, what happens is that the banks have conversations with their depositors and say, hey, we don't really want your money, but we have this great product. It's a money market fund. You can put it there. And so what's happening is that the Fed is pouring money into the banking system. The banking system has too much money. It pushes it out. It goes to a money market fund. Okay, so money market fund usually will take that money and invest in all sorts of things. Short-term things that are, credit risk-free usually. So, what's happening is that there's not enough bills. So because the Fed keeps creating money and you have the debt ceiling going on, shrinking the amount of treasury bills available. So the money funds have a whole lot of money, nowhere to go. So they basically just deposit it at the Fed. And that's what it's there for. So the Fed basically has this facility being able to absorb excess liquidity into the system, and with intention of controlling rates, of course. So if you could deposit money at the RRP facility at 5 basis points, then you wouldn't be willing to deposit it elsewhere at 4 basis points and so forth. So it's supposed to manage the side effects of QE on a quantity level, too much deposits in the system, but also to control rates so that rates don't go 0 or below.
So in a way, the problem here is that there are too many reserves in the system, and so there's
well, I wouldn't. So this is kind of a complicated point because you have the system where banks hold reserves as money, but you and I, who are not banks, hold deposits as money. So it's really a problem that there's too many deposits in the system, because the banks, they don't actually invest in the RRP. It's the money funds that do. And so the money funds, they hold bank deposits and they put them into the RRP.
Got it. And you also mentioned sort of the two most dangerous words in monetary economics, and that's quantitative easing. And that's sort of what everyone misunderstands. So could you talk about, number one, how the mechanics of quantitative easing actually work, and number two, does quantitative easing actually lead to inflation by and of itself? Because there's a lot of debate around that, and so I just wanted to hear your thoughts on it.
So the intention of quantitative easing is to put downward pressure on longer term interest rates, right? So the Fed as a central bank looks at the world through the lens of rates. And so usually it cuts its overnight rates. And when your overnight rates are at 0, then it tries to put down the longer term rates by buying lots of treasuries. Mechanically, what you do is that you're taking treasuries out of the system and replacing them with bank deposits. So for example, if you had $100 in treasuries, and then the Fed bought that, then at the end of the day, you would have like a bank deposit at your, let's say, Citibank or JP Morgan or something like that. The difference would be there's two differences really. So one is that you had a little bit of yield on your treasury, let's say 2%. Now you have a 0% yielding bank deposit. The other difference is credit risk. So used to be, have no credit risk facing the treasury. Now you're facing a bank. And that's usually not acceptable to you or to investors in general. So what they do is they move along the risk curve. So they take that bank deposit and they'll either lend it to a corporation, or maybe they'll move further along the treasury curve. And so that's mechanically what happens. And that's what puts downward pressure on all rates. So whether or not it's inflationary, I think you can look at it in a couple of ways. First, you really shouldn't look at it in terms of the quantity of money, because if you really think about it, treasuries are a type of money in the financial system, right?
Yep.
So you have like a dollar bill issued by the US Treasury, and you have a US Treasury issued by the same thing. It's just money that pays interest. So what the Fed is really doing is kind of changing the composition of money rather than the quantity. And that compositional change has an enormous impact on people who are institutional investors, right? So if there are fewer treasuries in the world to hold, then maybe I have to, and I have a say a return target, then I have to go do corporate debt, for example, and then or maybe move to 20 years, 10, 30-year treasuries. So it causes massive inflation in asset prices. So we see that in the rates complex really easily. I think what you would, and people focus on the impact on equities a lot, but mechanically what happens, and you can see this very clear in the data, is that because the rates for term treasuries become so much lower, longer-dated treasuries, corporations start issuing a lot of debt. And post-quantitative easing, post-financial crisis, the amount of corporate bond borrowings skyrockets, right? So
Yep.
Corporations are borrowing a lot, taking that money and buying equities. So that's kind of a mechanism there that QE is kind of inflating asset prices. But in terms of real inflation, goods and services, you don't really see that, right? And we do this experiment throughout the world. QE's impact is through the financial channel. And I think that has to do with just who it impacts. It's impacting the institutional investors. And so things that institutional investors buy go up in price. So whether or not it's inflationary, it's inflation for asset prices, and that's pretty obvious.
Yep. And so why do banks actually, participate in QE? Because, they're giving up something that yields 1 to 2%, and instead they're getting IOER, which is roughly 10 basis points or so. So why do they actually do this sort of exchange?
So banks, there are changes in how the banks are approaching this. I will talk about how it was, let's say, before COVID, and I'll talk about how it was recently. So banks actually usually didn't hold that many treasuries. The people who sold the treasury to the Fed were not the banks. They were like the investment community and so forth. What's changed so far, and I have a post about this, is that banks are buying more and more treasuries. And this is kind of new. I think what happened was that, like you mentioned, they have IOR that's yielding, 15 basis points today. And instead of holding a 15 basis point reserve, they prefer to hold some treasuries. Structurally, what this means is that a very big bank, has something called an HQLA requirement. So they're forced to hold a very large amount of very high quality liquid assets, and they can choose what to hold within the HQLA portfolio. In the past, it's largely been reserves, but now it's shifting more towards treasuries a little bit. They hedge the interest rate risk, of course. So, I mean, it's basically a play on, I guess one way you can think about this is, if you're a bank and you bought a bunch of treasuries and you hedged it into floating, then when rates go higher, then your interest income goes higher too, right? So you get that upside. But on the liability side, there's so many deposits in the system, you could kind of assume that your funding costs will always be around zero. So it's not, it's not a bad strategy.
Yep. And the other thing is, so what exactly is the role of reserves in the system? So a lot of people, so number one, the reserve requirement is 0%. So why do banks sort of hoard all these reserves? And number two, are these reserves primarily used to settle intrabank transactions, or are they actually used to lend in the real economy?
Yeah, that's a popular question. So reserves are used, it's a special type of money, right? You can kind of think of it like electronic cash, like in CBDC almost, but you can only hold reserves if you have an account at the Fed, a Fed account. So you can't actually lend it to people who don't have Fed accounts. So that doesn't really work. But banks hold reserves for two reasons primarily. One is because they have HQLA requirements, and the second is to settle bank payments between banks. So pre-crisis, banks, so during the financial crisis, they had liquidity and solvency problem. So post-crisis, in order to fix that, the official sector came out with a set of regulations called Basel III. And one of the impacts of Basel III is forcing banks to hold a ton of liquidity. So that way, if there's an emergency, let's say a panic, and everyone was withdrawing their money from the bank will have tons of liquidity to meet that. So that big HQLA portfolio, it's either going to be held in reserves or in treasuries. And so that's kind of a big driver of demand for reserves. But as you mentioned as well, when a bank settles payments, it's done through reserves. So they have to hold some reserves to settle that. But the major driver these days is just regulatory requirements. And they're fairly stringent. So like, for example, a big bank like JP Morgan has 3.2 trillion in assets and about $500 billion in HQLA. So, that's like 15% of its assets.
Got it. In times of crisis, so does the Fed in general just pay a lot of attention to specific rate spreads, LIBOR, OIS, and then, you've got the forward rate agreement OIS, so the FRA, OIS spread, so on. And, could you give some examples of how the Fed would actually go about trying to calm such spreads, when things start to go, crazy, like we saw in March 2020, for example?
Absolutely. So you're exactly right that those rates like the LIBOR OIS. So LIBOR is basically a credit risk rate, and OIS is a proxy for the path of Fed policy. So when the spread between LIBOR and OIS widens, that means there's more credit risk or systemic risk in the financial system. So that's one rate that the Fed will closely watch. The other is the FX swap bases, which is basically how much it costs foreign banks to borrow dollars using foreign currency as collateral. So that's something that it watches as well. These are important metrics, and the Fed watches them very closely. One is because they're measures of whether there's any systemic risk in the financial system, and the other is because the Fed has a mandate, and that's rate control. So when you see short-term funding rates rising, then the Fed has maybe not able to do its job of controlling the short-term rates. So that's what it does. And every time you see crises, you see these short-term rates blow up. You saw them during the Great Financial Crisis, and you saw them last year during COVID. So during COVID, you saw LIBOR as a spread of OIS widen a lot, and you saw the FX bases widen a lot. And those were directly addressed by a bunch of liquidity facilities the Fed put out. So in terms of the offshore dollar system, and which is kind of reliant on the FX bases, FX swaps, the Fed released their FX swap facility, which ended up lending, I think about $450 billion to foreign banks. So that's a huge backstop. Once you do that, the spreads kind of shrink a lot. So in terms of like the LIBOR and so forth, the Fed basically provided liquidity for the money market funds. And for the foreign banks too, if they wanted to, they had the discount window, but they had the FX swap too, so that was fine. So whenever things like that happen, Fed as a central bank, it's one of its key responsibilities is acting as lender of last resort. So it jumps into action, and you've seen it lend hundreds of billions of dollars into the market, and it's worked.
Yep.
It's a lot of money too.
Yep, got it. And one thing that's also been very controversial is this transition from LIBOR to what is SOFR. So what is your take on that?
Yeah, so LIBOR is basically an unsecured rate. It's a 3-month unsecured rate. And the way that it's determined, it's that you have a whole bunch of banks in London submitting what they think that they could borrow after 3 months. And then that number is aggregated and you get LIBOR. And during the financial crisis afterwards, it came out that it appeared that some banks were manipulating that benchmark. And the regulators really didn't like that. And so they wanted to have a new benchmark that was more robust and that could not be manipulated. And so they came out with this new benchmark called Sulfur. Now, what Sulfur is it's basically it's a repo rate. So it's an overnight repo rate with treasuries as collateral. The benefits of Libor, of Sulfur over Libor is that it's backed by this huge market. So every Sulfur volumes are like $1 trillion. Whereas there's not that much activity in Libor borrowing. So it's thinner. So I guess it's more possible to manipulate it. But the thing is, they measure very different things. So Libor has a credit risk component to it. So when things go bad, Libor goes higher, like during COVID, right? But the secured rate, it's different. When things go bad, it tends to go lower. So they're kind of measuring different things. And the Fed wants to push Sulfur to everyone as a replacement for Libor. And the take-up has been mixed. The official sector, like Federal Home Loan Banks or Fannie or Freddie, they're all on board. They support the home team.
Yep.
But the private sector, though, not as much on board. So you have all these. The problem is that, so if you're like an investor and you are lending someone in with a Libor-based thing, right? So that means that when there's systemic risk, you're going to get a higher return because Libor risk goes higher, right? So you should receive a higher return because there's more risk in the system.
Yep.
But if you are lending based on Sulfur, then just as bad things happen, you get no return. So that's not good for you. So there are some alternative benchmarks created by the private sector now that are trying to replace Libor in a way that would satisfy the regulators. Bloomberg has this index called the BSPY, which is kind of like Libor, but it takes advantage of its Bloomberg's data capabilities and does a more robust calculation, and that's getting some interest. So we'll see what happens. Oh, of course, one other thing that people don't like about Sulfur is that it's an overnight rate, whereas Libor was a term rate. So they kind of want to see what the forward-looking term structure would be. And there are ways that they're trying to do to fix that using the futures market.
Yep.
So basically where the Sulfur futures are trading, you can get an implied rate, but that's still in its infancy. No, I think Sulfur is really useful for transparency. I mean, it's $1 trillion market. If not for Sulfur, you really would have no idea how large the repo market is or what rates were, unless you were a dealer. But it's a different rate than Libor, and the market thinks that as well.
Got it. So another topic that I wanted to jump to is what the Federal Reserve is doing in the MBS market. So could you explain how QE in the MBS market works? And number two, what impact does MBS QE actually have on the real housing market? So does that actually influence lending in the mortgage market, or does that actually influence housing prices? So how does that work?
So that's a good question, and it's on people's minds a lot. So obviously the Fed operates through the lens of rates, right? So when you buy mortgages, you're lowering the mortgage rate. And so the mortgage market is actually like this. There's like a mortgage rate that you and I face, and then that mortgage gets sold to Fannie and Freddie and becomes a security, and then gets sold to an investor. So and that's what the agency MBS is. So there's a spread between what the agency MBS rate is and what the treasuries are. And when you buy mortgages, you're lowering mortgage rates and you're also narrowing that spread. And what the Fed ultimately wants to do is it wants to have lower mortgage rates for everyone, and that stimulates housing. And the Fed first started buying mortgages in size during the GFC because there was a huge dislocation in the housing market. So it made sense for the Fed to buy a lot of agency MBS. Today, it's not that clear what it's doing. But yes, if you buy a whole bunch of mortgages, you have lower mortgage rates. But there's a couple ways you can do that though, right? If you just bought treasuries itself, maybe the spread between mortgages and treasuries would be wider. But then because treasuries are lower, the ultimate mortgage rates are also lower as well. So it affects housing markets in the sense that lower rates affect housing markets. So I don't think that's a huge impact. It definitely does have some impact, but let's say you're getting a 3% mortgage, or instead of getting a 3% mortgage, you're getting a 2.9% mortgage.
Mm-hmm.
On the margins, maybe people are going to buy more houses like that, but it's a small impact, I think. But I think you're right in that it does seem strange for the Fed to be buying so much MBS when there's no housing crisis and housing prices are at all-time highs. If they wanted to have lower mortgage rates, buying treasuries would do the same thing. it would just lower treasury rates, and then mortgage rates, which are spread to treasuries, would also come down as well.
Yep, got it. And so, how much does lending actually drive inflation? So, there's a lot of talk about, QE does not drive inflation, and real world lending is actually what drives inflation. So could you just talk about, number one, what the biggest drivers of inflation are, and number two, what the biggest drivers of commercial bank lending is?
So I think of the world through the lens of money. So whether or not you have inflation depends on how much money you have and who has it. And well, the money comes from two places. It comes from commercial banks, and it can also come from the government.
Yep.
So when you have a lot of commercial banks lending, you're basically lending to people who are struggling to spend money, right? Because otherwise they will not get a loan. So that creates new money, and that creates spending, and that boosts the economy and growth and inflation. But what's happened in the past couple of years is that the government has created tremendous amounts of money. So I wouldn't focus on what the Fed is doing, but I would focus on the Treasury is doing. Remember, Treasury issuance is a little bit like printing money, right? And so what the Treasury has done, it's basically, let's say, printed $4 trillion and spent it. And the Fed took those treasuries, bought them, and changed them into bank deposits. The good thing about this is that when it's a bank deposit, it shows up on the balance sheet of a bank, so you can actually see where all the money went. So when I look at the regulatory funds and banks, you can kind of see just the level of the increase in the amount of, not just among the institutional investors, but among normal people as well. Just with the way that banks report their deposits, there's a lot of different ways they report it. But one of the ways they report it is whether or not the account has $250,000 or more or less. Now, let's say the smaller accounts with $250,000 or less, if you just look at their balances over the past year have increased by $1.3 trillion. So that's like mom and pop shops and people like me and you have $1.3 more trillion to spend. So you don't actually need banks to create lots of credit when you have the government doing it to such a large extent. And as you would expect, you have a whole bunch more money in the system. The distribution of it is well, it's still tilted towards the institutional side, but the smaller accounts have a lot as well. And you see basically prices rise everywhere. You see housing prices rise, you see commodity prices rise, groceries, and of course you see financial prices rise as well. So, you have more money, prices rise. It is just as you would expect it to be. But you're right that also noting that, and a lot of people have looked at this, and they're saying that commercial banks aren't creating as much money as they used to. So the credit growth, like the loans to commercial and industrials, are not as much. It's kind of flatlined a little bit. Mm-hmm. So that's a little bit misleading, actually. And it's misleading because there was $800 billion in PPP loans to small businesses. So that shows up on a bank's balance sheet, but when it's forgiven, it disappears. So if you have $800 billion in loans to businesses, and right now, so far, about 400 have been forgiven. So that takes away loans on the balance sheet of banks. So the amount of commercial lending by banks is actually higher than you would think just based on what you see on their balance sheets, because some of the loans are forgiven. And really, if you just got an infusion of $800 billion, you probably don't need to borrow that much right away.
Got it. And so the Fed cannot legally directly monetize the debt, right? So it has to go through a primary dealer, which is typically a commercial bank, and then so they buy the debt from the Treasury at auction, and then the Federal Reserve buys it from the primary dealer, right?
Yes. So the primary dealer buys it at the Treasury auction, like you said. They're not always banks, but they're usually affiliated with the bank, and they sell it to the Fed. Yeah.
Got it. And so so does the Federal Reserve actually care about where financial markets are, or where the stock market is? So, there's usually a lot of accusation that the Federal Reserve acts on the basis of how stock markets are trading, and the only goal of the Federal Reserve is to make the markets go up. But, how true is that? since you work like literally at the Fed. So does the Federal Reserve actually care about where financial markets are, or is that sort of a smaller consideration? How does that work?
So I think they will tell you that they don't have a target or anything like that, but I mean, obviously they do care. And one way you can think about this is that the Fed is kind of run by boomers who want to retire, and maybe they're looking at their 401k every day, and maybe they don't like it when their 401k goes down a lot, right? And they're in a position where they can do something about it. So another way to think about this is the equity market is kind of systemically important. You have a lot of people whose retirements and savings depend on it, not just individuals, but let's say institutional pension funds as well. And you kind of have this policy of the wealth effect that was started once upon a time. So when you have higher asset prices, boost sentiment, maybe it encourages spending, maybe that could puts growth and inflation, upward pressure on growth and inflation. So it seems like it is one of the mechanisms through which policy is transmitted, just having higher asset prices. So they obviously do care, right? I mean, I think the Fed always kind of leaps into action when you see the equity market go down a lot.
Yep. Yep. So also, what is the role of gold in the current monetary system? Because, a lot of people describe gold as a barbarous relic. And then, the other side of the debate is, they're just long gold and, they're called gold bugs. And what is the role of gold? And, why do central banks, have so much gold on their balance sheets?
The Fed has a bunch of gold on their balance sheets. You can actually take a tour of the Fed's gold vault. It's super cool. It's 7 floors underground. It's a lot of gold. I think it's really just a legacy of the gold standard. I mean, so when you're on the open markets desk, you monitor things that the Fed cares about, and they never ever care about the gold price or Bitcoin either. So it's not something they think about. Gold, I mean, people can think of it as an inflation hedge, although I don't know what the relationship is. It seems to be more like a hedge against, government or systemic risk, right? So otherwise, everything you have is in an electronic entry somewhere, right? It's in a database. What's in your bank account, what's in your broker account, it's just electronic database somewhere that you have no idea. But if you have gold, you kind of have an asset that is outside of the system. So I think it's a good hedge for that, along with canned food and things like that. But that's not to say that gold prices could not go higher, but it doesn't have monetary value today.
Yep. Also, another thing is, Milton Friedman is famous for his MV equals PQ equation, where he says that, you can typically predict, and his famous quote is that, inflation is everywhere a monetary phenomena. But then from the 1990s, what we've seen is even though the money supply or the M2 supply has gone straight up, we've seen velocity absolutely collapse. So number one, how useful are monetary aggregates in general? Thinking about inflation. And number two, what has actually caused velocity to just absolutely collapse from the mid 1990s to now, and especially post the great financial crisis as well?
Yeah, that's a really good observation. So if you thought, as they did back then, the velocity of money was relatively constant, then you could say, well, if you have more money, you will take it through the velocity multiplier, you'd have more growth in inflation. But that hasn't. I think from my perspective, I think it has to do with just the distribution of money. So velocity is basically GDP over money supply, right? So but if you have money and you don't spend it in things that produce goods or services, it doesn't really show up. So, but you can take money and you can use it to buy Tesla stock, or you can use it to buy other financial assets that don't affect the GDP, but it's still circulating. And I think that change in distribution of money, and people could think of it as wealth or income inequality, means that more and more money is held by people who don't spend it on GDP goods or services. And so the money is still circulating, but it just doesn't produce inflation or growth. It produces asset inflation. If you give a lot of money to a millionaire, he doesn't go and buy more sandwiches. He goes and he buys more stocks. He goes and he buys another house. I think that's what's happening. So it's not that M2 is useless. I think it probably shows something about asset prices, but it probably doesn't show very much what real economy stuff on this distribution for money changes as it is now.
Mm-hmm. Yep. But wouldn't so a lot of a lot of the expansion of the money supply has typically been just reserves on bank balance sheets. So how does that kind of actually lead to increases in asset prices? Because these are just reserves sitting on bank balance sheets. So how does that cause stocks to go up?
Yeah, so the banks don't spend their reserves on equities, obviously. So the focus wouldn't be on reserves, that's the asset side of a bank. It would be on the liability side, the bank deposits, which is the money you and I hold, right? So what QE does, it increases reserves in banks, yes, but that's not that important. Banks can spend their reserves on whatever they want, but because of regulations, it's really constrained. So they're basically stuck buying things like treasuries. But for you and I, when we have like money in our bank account, we can go buy anything. And what happens is that, so we have a whole bunch of bank deposits. We go and we buy, let's say, corporate debt, or we go buy equities. And the corporations issue a lot of debt to soak up those deposits, and then they go and they buy equities. Basically, it's kind of like a hot potato effect where people don't want to hold 0% yielding bank deposits that have credit risk, and they just kind of keep swapping along. And in that process, things like corporate debt and equities and longer term treasuries all rise in price. So,
yep. And how much does narrative play a role in all of this? So, for example, Jeff Snyder has talked about how the Federal Reserve uses what he calls expectation policy. And what they do is they go out to these press conferences and so on, and they say, hey, look, we know we're printing all this money. And then, people start to think, hey, look, the Fed is printing money, we might see inflation, and then they go out and buy a car, the market participants, the investors, they start to change their expectations. Okay, the Federal Reserve is behind us, and then they go ahead, they start to buy stocks, and that became known as the Greenspan put or the Fed put. So now, how much does narrative and changing expectation, how much does the Fed matter in narrative and changing expectations?
So narrative and expectations are a tremendously important part of the Fed's toolkit. The best type of monetary policy is the kind where you actually don't have to do anything, what they say, open jaw operation. So that we can see a good example of that through the corporate credit facility last March, right? So the Fed bought about $11 billion of corporate debt. The corporate debt market itself is like 10 trillion, and 11 billion is just nothing. But just by doing that, the market kind of went into a frenzy, and the corporate bond market illiquidity was just like solved just like that. So expectations and narratives are tremendously important. More formally, the Fed has something called forward guidance. And what that is that it's committing itself, or it's letting the market know what it will do with short-term interest rates. So usually the Fed just adjusts the overnight interest rate, right? And when they do forward guidance, let's say they'll say, okay, I'm going to keep rates at 0 for the next 5 years, right? So that basically allows them, through the expectations channel, to shift all interest rates going forward to, let's say, 0. So just by saying that and being credible, then they just kind of, without doing anything, they flatten the curve tremendously. So having credibility is tremendously important to a central bank, because when you have credibility, you can move markets without actually doing anything.
Got it. Another thing that that Jeff Snyder has talked about, Jeff Snyder is gonna come up a couple of times. So Jeff Snyder has talked about how the Eurodollar system, the system where there are offshore dollars, so dollars that are out there that are deposited in banks or are just bank deposits outside the United States, and therefore outside the Federal Reserve's jurisdiction. So he argues that system has created a shortage of dollars because there are more dollar liabilities than dollar deposits. So there's basically a mismatch between dollar liabilities and dollar deposits. So what are your thoughts on that? Do you think that the dollar shortage thesis as a whole is valid?
So we have to go back, like I mentioned, where do dollars come from? Either they come from the government or the commercial banks. When you look at the offshore market, let's say an offshore bank creates a dollar. So at the same time, it creates a dollar liability, it creates a dollar loan, right? So it's balanced. So the difference when you're an offshore bank, so in general, banks match their currency assets and liabilities. So if you have like a dollar liability, you have a dollar asset. And the thing about the offshore market is the kind of liabilities that you get. So if you are a domestic bank, then you have a lot of retail deposits. And in the time of crisis, the retail deposits stay on your balance sheet. So, you don't have to worry too much about a bank run. But if you're like a bank in Africa or Asia or in Europe, you don't have these dollar retail deposits, right? So you have to go to the wholesale market to borrow. The wholesale deposit market is very different from the retail market. So whenever there's a crisis, they're the first types of depositors to run. And so what you perceive to be a dollar shortage is really just depositors that are very sensitive to economic conditions. So let's say last year, COVID, there's a tremendous run. If there was a tremendous run in certain parts of the market, then, the retail deposits would stay put, but the foreign banks, they would lose dollar deposits because they're borrowing from the institutional investor community, which is very risk averse. And so that's perceived as a shortage. Now, the Fed knows this, and so it actually backs the offshore dollar market the same way, in a similar way than it backs the onshore market. So onshore, Fed plays lender of last resort. If a bank needs liquidity, it has too many outflows, it doesn't have enough liquidity to meet those outflows, the bank can go into the discount window, borrow from the Fed, and meet those outflows. Foreign banks usually don't have access to the discount window. So what happens is that the Fed has something called an FX swap line, which is kind of like a discount window for foreign banks. So what happens? Let's say a French bank needs dollars, right? So then it will go to the ECB, and the ECB then would use the FX swap lines and borrow from the Fed. So the Fed lends to the ECB lends to the French bank. It's indirect because the Fed faces the ECB instead of facing a bank, but the foreign banks still get supported. So in a sense, the Fed has kind of become lender of last resort to the offshore dollar system as it does to the onshore system. And I think that takes off a lot of tail risk for the offshore system. And that I think it strengthens the stability a lot. So.
Got it.
Yeah,
And
yeah. So the Fed did this in the Great Financial Crisis and in COVID. So, and the swap lines are still active too. So I think that the market perceives that the Fed will be there if something really bad happens to the offshore banking system.
Yep. And what other ways can the Federal Reserve intervene in the FX market? So one way you mentioned, in a way, it's swap line. So for example, when Turkey last year had a dollar crisis, there was a lot of talk about whether the Fed would extend swap lines or maybe they wouldn't. So what other ways can the Federal Reserve actually intervene in FX markets?
So you want to think about what the purpose of intervening is. So a lot of times it's just really rate control. So the thing is, if you're an offshore bank and you suddenly all your depositors are fleeing and you have to go and borrow in the market, that drives interest rates higher, and that spills over to domestic interest rates. And so the Fed has a rate control problem. So that it's in the Fed's interest to be lending. That's the rate control aspect. And sometimes there's an FX aspect as well. Maybe the dollar is too strong, as it was, let's say, some in periods in the past. Then the Fed can directly intervene, just print dollars and sell them. So the Fed hasn't really intervened directly in FX for a really long time.
Yep.
Every quarter, the Fed publishes this FX report saying whether or not they intervened, and they haven't. They actually do have some foreign currency. They have the Fed together with the Treasury have $40 billion that they could, and foreign currency that they could, but they don't need to. Also, I think it's worth noting that the FX policy is not really what the Fed decides. It's the Treasury's policy, and the Fed just kind of does what they tell them to. So, but most currency intervention is indirect now through the FX swap lines. Now, if there were no FX swap lines last year, the dollar would strengthen tremendously.
Yep.
But the FX swap lines kind of put a lid on that. So it's more indirect these days.
Got it. And so one thing I wanted to get your view on as someone who has worked at the Fed. What is your view on inflation? Do you personally think it's transitory or not? And And what are the conditions that you think the Federal Reserve would have to see for us to, for us to see them start tapering their balance sheet?
So I think of inflation as really a political choice. So any country can create inflation as much as they want, or they can create deflation as much as they want. You want to create deflation, you just raise taxes 100%, interest rates 1,000%, boom. If you want to create inflation, you just print money and spend trillions. And I think that that's what we're doing right now. And it's not so much about economic fundamentals or productivity or all that, but if you have a government that is determined to just print money and spend, that you get inflation. It's really that easy. If you look at a chart of the U.S. Treasuries issuable, okay, the U.S. debt, it's going parabolic. And right now you have the Senate talking about another 3.5 trillion on top of the 1 trillion infrastructure that they just passed. So it seems like the culture is there to just continue spending. And if you do that, you get inflation. That's, of course, right? Print money and spend. What was your other question?
So what conditions would the Fed have to see for us to see?
Yeah, that's the crazy thing. Yeah, so right now, you want to look at it globally. You have Canada tapered QE a while back. You have the emerging markets raising rates. So the Fed is definitely talking a lot about tapering these days. They probably will soon, maybe like by the end of the year. And they have their views on growth and inflation and all that stuff. But the thing is, a lot of what's driving inflation these days is what the fiscal authorities are doing, what Congress is doing, and the Fed doesn't have a lot of control over that, right? If the Treasury, the Congress wants to spend another $3.5 trillion, what can the Fed do? It doesn't have a lot of options, right? So even if it raised rates or even if it tapered, well, Treasury is still spending. It doesn't really change anything. So in my view, it seems like this kind of makes the Fed's role a bit smaller than it used to, simply because it doesn't have any control over what the Treasury does, and the Treasury really doesn't care where interest rates are. If you had a private actor and the Fed raised rates, maybe there'd be less borrowing, but not the US Treasury. It doesn't care.
Yep. And what are your thoughts on the Federal Reserve talking about these CBDCs? So, we started seeing them in China with the digital yuan, and we had Lagarde talk about the digital euros. So what is your take on CBDCs, and how do you think that's gonna play out?
It does sound like, we're probably going to get a CBDC. I think that's a really good question. But when I think about it, when I heard this, I thought it was strange because I don't really understand what the need is. I mean, for me, and I don't know about you, I feel safe leaving money in my bank. I don't really have that much, right? When I pay, I swipe my credit card, payment goes instantly. It's cheap, and I get all these points from Chase. It's great. So I don't really know what the role is, and I think though that you can think about it in two ways, and it depends on the implementation as well. You can implement it like a digital, like a bearer instrument, like a digital cash, something you maybe put on your cell phone or something like that you can just kind of tap and it's gone. Or you can make it like a bank account where everyone has a bank account at the Fed. So in a sense, they have reserves as well. So yeah, I think a lot of it depends on what the purpose is. When I hear the official text talk about this, they talk about things like improving competitiveness, safety, and banking the unbanked, but it seems like I don't perceive that to be a big problem. I mean, if you wanted a bank account, there's so many banks you can walk in, they'll give you coffee and they'll make a bank account for you. And, the Fed is not going to do that for you. And you have insurance for deposits, so it's not going to make anything safer. So I don't really know what the purpose of it is. And I guess what you can think of is just an additional policy tool. Let's say the Fed has everyone on CBDCs, and they can kind of control what the interest rates are more effectively. There's this book by Rogoff about the curse of cash, and what he talks about is that, if you have CBDCs, you can do negative interest rates. Well, I mean, that didn't work out so great in Europe and Japan, so I don't know why we're doing that. But yeah, if you have CBDCs, you could do that very effectively. So maybe it's just having more control for the system, which, which maybe it's good for them, but I don't know about us.
When we were talking earlier about QE, you pointed out that while QE has caused asset inflation, what it hasn't caused is real economy inflation in consumer goods. So would CBDCs actually change that? Because if you bank the unbanked and then you give a lot of these people money, well, wouldn't that change that dynamic and make sure that we see consumer good inflation as well?
So when the government wants to give people money directly, they can still do it. They do it like, last year we had these massive stimulus checks that was sent out to everyone. CBDC only makes that smoother. It makes the implementation smoother. We don't really need CBDCs to do that. What a CBDC could do that like this kind of stimulus program wouldn't be able to is to just really make rates negative or targeted. Like say, according to the IRS, you have, $500,000 in income. So, you have a lot of money. I'm going to make you spend. I'm going to give you negative 10%. You can make things like that. That gives you more policy tools to do that. But in terms of just getting money out to people, you don't really need a CBDC to do that. But it makes it easier for sure.
Yep. And if the government started to directly monetize that, would we see inflation? Because there's actually a school of thought, and what they argue is that let's say the government goes and buys an F-16 from Lockheed Martin, and then Lockheed Martin, whatever they get, they just go ahead, put that in their bank account, and then that just ends up as a bank deposit, and hence, we won't really see much inflation. So would government directly monetizing that, would we see inflation? And if we started to see post-Keynesian theories or modern monetary theory, if that became the mainstream, would we start to see inflation? How would that play out?
I think we already have monetary theory, and we're already monetizing desk, and we're already seeing inflation. It's happening right now, right? So you got the Fed buying $80 billion a month in treasuries. So we just did 4 trillion in spending last year. We're going to do maybe another 3.5 trillion in discussion. So that sounds very MMT-like to me. So Fed is going to monetize it. And so it seems like we're already living that world. And as you know, we're seeing inflation, right? So it seems like we're heading towards that. So like I mentioned, I think of inflation as more of a political choice. And if you keep doing this MNT style world, MNT style spending, then you're going to get inflation. There's really no way around that. That would be, it'd be an interesting problem, because ultimately, if massive fiscal spending is causing inflation, then you to stop it, you'd have to have massive fiscal spending to stop, and that's a really hard thing to do.
And one perspective on the Federal Reserve's function is that people say, for example, when the Federal Reserve started buying corporate debt and high yield debt, that sort of creates a moral hazard, so that companies can now be a little more careless because they know that the Federal Reserve is going to end up buying the debt anyway. Do you think that is something that's real, or do you think that's just nonsense?
No, absolutely, it's real. I mean, if you have basically what people think of the Fed put, then you can take more risk. The way that the Fed usually deals with things like that, it's through regulation. So let's say back during the financial crisis, you had the Fed didn't want to bail out Lehman, right? Because of moral hazard, let Lehman fail, and then everything kind of blew up. So then the Fed turned around and started bailing everyone out, right? So what they did afterwards, though, is make it more difficult for banks to take more risk and make them safer. So I guess the guarantee is still there. It just makes it more difficult for them to get themselves in trouble through regulation. So I think the Fed is still going to be there backstopping people, but if they perceive an area of the financial markets that has this moral hazard problem, then they will just put more rules to make sure that those parts of the market don't get themselves into trouble. For example, prime money market funds. There was kind of a run on money market funds last year, and the Fed backstopped them by providing a money market liquidity facility, right? So the Fed, when money markets needed liquidity, the Fed basically helped buy some of their assets to give them liquidity. And now they're thinking about imposing new regulations on prime money market funds so that they don't get in trouble in the first place. So the policy is just more what they would call prudential regulation than they would say pull back the guarantee.
Yep. And so far we've covered pretty much almost all of the functions that the Federal Reserve does. So what are the most common myths that people have on the way central banking works? And could you just talk about why those are wrong, and what's wrong with in their understanding?
Well, honestly, I would just in today's context, I would say they focus too much on the Fed's balance sheet and not enough on what the Treasury is spending, because I think that's just far more powerful in terms of just growth and inflation. And when you're already at the zero bound asset price as well, because the Fed is can't really cut anymore. And the second thing that I think that people think too much about is there's just no secret theory, conspiracy theory, or anything like that. There's no Fed buying equities whenever the S&P drops. Fed doesn't do stuff like that. Okay, just to be clear. I would just pare that back and think of Fed as more of a utility than some, I don't know, shadowy organization. And, yeah.
Yep. And going forward, what in your view is the biggest risk to the U.S. dollar, the U.S. dollar's hegemony, or the U.S. dollar, being the world's reserve currency?
So the Fed, I think, so the U.S. dollar is the world's reserve currency, and everyone uses it. The Fed has done a lot of monetizing recently, and I think that actually helps the dollar's status a little bit, because it takes off tail risk that one day there might be a liquidity scramble. So it takes off some tail risk and actually strengthens the dollar's role as a global currency, right? The only way you can dethrone that is actually, if there was a great liquidity crisis and a lot of people went bust because they didn't have enough dollars, then maybe they would stop using dollars. But as long as dollars are plentiful, there's no reason to stop. But fundamentally, a fiat currency is built on confidence in the system. And I think that if you people don't perceive that the US is being a responsible sovereign, that they're not managing their country well, like all the many decades of goodwill that the US has built up could be affected. I mean, let's say that you're Argentina or Brazil and you say, I want to do deficit spending of 20% of GDP. Immediately the currency would crash, and there would be huge market implications. But the US says this, and everyone's like, yeah, no big deal, because we trust the US. But when one day maybe that trust is perceived to be not merited, then I think things could change. Seems like we're on track for that.
Got it. Joseph, thank you so much for a wonderful interview. And before I let you go, could you tell the audience, where they can find you and more of your work, and talk about your book a bit as well?
Yeah, sure. So I write a newsletter called on fedguy.com. I'm also on Twitter, fedguy12.com. I write about monetary policy and mechanics of the banking system and financial system. Basically, I teach people how the system works. A lot of my writings on my blog are a bit more advanced, but if you wanted something that was more accessible, I have this book called Central Banking 101, which is meant for a general audience, and it's very well cited. So when I first got into this, I didn't really know how the financial system worked. And it's really hard to learn, as I mentioned, because it's so opaque. And so this is basically a distillation of what I've learned. And it's meant for a broad audience, but for those who are a bit more advanced, I also have a whole bunch of special boxes that talk about topics that'll be more of interest to a more professional audience as well. It's available on Amazon.com.
Yep. Awesome. Thank you so much for being on the podcast, Joseph. It was wonderful having you.
Thank you. Thanks for inviting me.